Welcome to episode 53 of Accessible Finance, where we demystify personal financial topics and answer your questions so you leave saying, I get it now. I'm Eric Johns.
And I am Rachel Johns.
Let's dive in.
Okay, Eric. We've had so much fun doing scenarios.
Let's
I have
go.
another one for us.
Yes, ma'am.
Okay. So this is a recently retired couple
Got it.
that is concerned that they have had poor asset management.
That's an unfortunate time to realize that you've had poor asset management.
Yeah. So the husband is 66, the wife is 64.
Okay.
So despite the concerns of poor asset management, they both have retired on the earlier side.
I mean, fair.
Okay. They were they wrote in their scenario in response. There was a post that was made that were like,
Why are we laughing at them?
It's not at them. It's at where I found it.
Okay.
So it was on a financial blog, and the initial prompt was like, what are some common mistakes that you've seen people make with money?
Okay.
Okay. So one of the posts or one of the responses was poor asset allocation leading to insufficient growth or high risk over reliance on like cash value life insurance as their sole investment vehicles.
All right.
It sounds like this person was talking from potential personal experience of someone in their life. So in response to that answer, somebody wrote this scenario in.
Okay.
Okay.
Let's go.
The person who wrote the scenario in had, okay, this is our situation. We're worried we might fall into this category. How do we optimize our asset allocation to ensure some long-term financial stability? Are there better investment options than cash value life insurance for our current needs?
I hope so.
And how I knew you'd like this one. And how can we manage our funds to ensure that they last throughout retirement while covering all of our expenses?
Okay.
It is important to note that this is a couple that has no children, no grandchildren,
Okay.
are not worried about legacy.
No legacy whatsoever. Okay,
Correct.
cool.
So they just kind of want to live.
So definitely a huge need for a whole life insurance. Wow.
We will discuss. But yes, because they were starting to feel buyer's remorse, it sounds like.
Unfortunately, we're a little past that point, but go on.
Well, so the goal is for them, as they had stated, was really just to ensure that their funds lasted through retirement. They would be happy to have the last one of them die with, 1 cent, 0 cents in the bank.
Got it.
Right?
Yeah. We want to bounce the last check. We're
right.
Good.
So one to the funeral.
Yep.
Okay. So again, they are 66 and 64. Okay. Their current bank balances is that they have $6K in savings.
Okay.
They have $20K in checking.
Okay.
They have $360,000 spread across various retirement accounts, was how they phrased that.
Okay. Well, how much was it?
$360,000.
360. Okay.
They have a $100,000 cash value life insurance policy.
Okay.
Their annual expenses are $64,000.
All right.
Their annual income, or what they're realizing, is $70,000, which is generated through Social Security and a small pension.
Oh, okay. Have they both claimed Social Security then?
That's a great question. They did not respond to that prompt on there.
They probably both claimed at 62 if they're already getting that much.
Yeah. Well,
okay.
So yeah, exactly. So they have $70K Social Security plus a pension, but they did state the pension was small. So
wait, they have $70K from Social Security?
$70K is the sum of Social Security and the pension.
I thought when you said it the second time that you meant that was only Social Security.
No, that is
that would have been improbable.
Well, that would have definitely then they definitely both would have claimed no. But yes, no, they have $70K with Social Security and their pension.
Okay.
They do have a $300,000 home that is paid off and a car without a note.
Got it.
But they wanted us to know it was worth $20,000.
Thanks. Thanks for that.
I think they were trying to just add up money wherever they could.
All right.
So yes. Question number 1 again for them was,
what was it?
How do we optimize our asset allocation to ensure long-term financial stability? They basically had stated that their current investments are, he had, or whoever, I don't know if it was the husband or wife that wrote it, but they had stated that there was $360,000 across various retirement accounts. Upon further questioning in the blog or financial post, they weren't really able to articulate what types of accounts or where they're invested. I
Got it.
think they're basically like, we are ready to just like start anew and just
Uh-huh.
do whatever is optimal. Um, so the question is, how do we optimize asset allocation?
Yeah, so where do we start? We start
It's
with cash
cash flow.
flow. Right. So we need to know if they're spending first, we need to find out if they're spending more or less than $70,000.
64,000 is what they said.
That's what they said they spend?
Yes.
Okay, so we need to make sure that they are spending $64,000. I
Correct.
did
We
write
wanted
that,
to
but
verify. Exactly. So, I mean, it's always really great to hear that you're spending less than
right.
you're making when the margins are tight. We've never really seen anybody get an accurate number on what they're actually spending. So we definitely are skeptical of that until we really see and verify the
Right.
numbers. But if we can act
That'd be
theoretically as
great.
though that is
Yeah,
truthful.
there are a number of questions, right, before we dive into their asset allocation. And given that they have no
Yeah.
beneficiaries, right, or legacy concerns whatsoever, that does point, if we're talking, we were talking on the last episode about when you might want an annuity.
Yeah.
That's a pretty strong argument. That's a pretty compelling argument. You have no estate considerations whatsoever. You want to bounce the last check. Don't actually hate the idea of some kind of an annuity product here. I would
What kind, though?
single premium immediate annuity probably, or joint and survivor with joint and survivor provisions, right?
Yeah.
So that seems like a good place to what is it, 1035 exchange your whole life policy.
So can you speak a bit to how, don't get too granular on me, but like,
Okay.
let's say I have
Just wanted to
$100,000.
make sure I was right about the 1035. I couldn't remember if it was 1035 or 1031.
Like
I had to
math
be
right.
right.
Okay, you're right.
I was right.
So like if I have 100 or they, uh, Bruce and Rachel have $100,000 cash value, life insurance.
Hmm.
If they wanted to,
1035 it into an annuity. It's
correct.
basically the equivalent of trying to get an annuity with $100,000 in cash without a tax consequence. So 1035
Okay.
lets you avoid the tax consequence. So like
You
just
don't
I don't
lose
want to sidebar too much.
the value though.
The
Like,
cash value?
yeah.
No.
Okay.
So it depends. It depends on the policy. We'd have to read the
Yes.
policy and the documents and surrender terms and all the other things. But if they've had it for a
Correct.
while and their cash value is $100,000, typically what'll happen is you can access that cash value. But if I just rip the $100,000 out of the policy, I might and likely, well, maybe not likely, but I might have a tax consequence, right? So if my basis is $80,000 and then I pull out $100,000, that $20,000
Is
is taxable,
guaranteed. Yeah,
right?
exactly.
I want to say it's taxed at ordinary income, but I could be wrong. I'd have to verify that.
Let's just
Anyway,
say tax.
it's taxed, right?
Yes.
So the idea is you can 1035 it and avoid paying tax on that $20,000
Hmm.
if you wanted the product that you're going to go 1035 into anyway. Maybe we already know we want an annuity. So we're either going to go buy an annuity with the rest of our $300,000 in retirement accounts, or we could just roll this $100,000 cash value life policy
Hmm.
into an annuity. So we might want to do that.
Well, so you've said that the annuity is a viable option.
It's an option. It's
Now,
not the only option.
sure. Now, in this though, why would we
Do they have a
rather?
house?
They do
What was it,
300,000.
okay. So that's a little bit of a parachute. Like they could use that. They could take, a home equity line of credit or something like that. Um,
I
or
believe
reverse
later on
mortgage
in
rather.
the blog they also discussed like, should we be looking at downsizing to like have extra cap, like we're not opposed to like selling our house and getting a smaller,
Gotcha.
condo or something like that.
So like they could look at reverse mortgage if they're not looking to hedge the longevity risk. And longevity risk, just to be clear, is living past like an ordinary life expectancy.
Like
Or
a
do we think they're going to live
90-ish.
too long,
Right.
right? They're worried about living to 100. And what happens if I run out of my money before
Yeah.
100, inflation, everything else? You could lean on your house, right? Because we said they don't want anything left. They want
Correct.
$0 in their accounts.
Correct.
And they want to kind of, burn that candle on both ends until they're at zero.
Correct.
Okay.
And they want to do it
It's completely
in
reasonable.
a pretty equitable way rather than like we're going to blow through a chunk of it now and then have
Right.
austerity measures for the remaining.
Right.
Right.
So it makes sense. It actually makes sense to do something like, or it might make sense for them to do something like have an inflation indexed annuity or something like that.
If I was to roll my cash value life insurance plan into an annuity, then I would be getting rid of my cash value life insurance plan.
Good.
Why is that good?
Because well, it might not, right? It might not be if there's some problem that they already have with if there's a health concern with, maybe the 66-year-old and the 64-year-old is going to depend on the death benefit. We don't know anything about the policy other than it has a 100K
Correct.
cash value, right? It could have like a $4 million death benefit, and the 66-year-old could have like terminal cancer. God
Correct.
forbid. I hope it's not,
There
right? But
was nothing mentioned. I will say this is not to say that there is
so like
nothing there, but there was nothing mentioned
there
about
are
the
very
benefits.
few no-brainers, okay? So like we would have to look at the situation and explore just the options. But like the idea is that if we're not trying to pay for a mortgage, we're not trying to
Right.
solve some estate tax problem, we're not really worried about the death benefit doing anything meaningfully to change our financial picture, right? Then we might not need the whole life policy. We may never have needed the whole life policy,
Right.
right? Like so if it's not part of a buy sell agreement, there are very few factors here that we're seeing as like, oh, that's definitely a reason to have a whole life insurance policy
Sure.
or life insurance at all,
Right. Right. Right.
right? Because that's the first question when we're talking about permanent life insurance. Do you even need life insurance?
Right.
Like if I were to sell you a term life policy today, and if I were to come to you and say, "Hey, I've got this really cheap term life policy for you," if your answer to that question, and I'm like, "Do you want it?" If your answer to that question is no, you almost certainly should not have a permanent life insurance
Yeah.
policy because you don't need life
I
insurance.
think that it's really important to clarify that like we are in no way anti life insurance,
Mm-mm.
but I think that we are very anti buying any kind of insurance that you do not need.
We're correct. We're huge proponents of being intentional
And efficient.
about what you're getting, like
Yeah.
what you need, right?
Yeah.
Like getting only the things you need.
Correct.
So like another thing is they have no like we'd have to look at the pension too. Like does the pension have any survivor benefit? And
Correct.
also is it inflation indexed? Okay, so that could be a reason for insurance, right? On the person whose pension it is. If there are no survivor benefits, right, then we might need to have the death benefit provide that or
The
help to
replacement.
supplement,
Yeah.
yeah, like serve as a substitute for that pension, like that stream of income,
Correct.
that portion of the income.
That's what you're
Yeah,
like
and their
planning
Social
to live on
Security.
forever.
Like the
Exactly.
surviving spouse is going to get the higher of the two benefits from Social Security,
Sure.
but still, maybe I'm making 3K and you're making 2K,
Right.
right?
I'd still
When I
three instead
die,
of five.
you get three, but
Right.
you no longer have five. So you still lost your two,
Correct.
right? So we still there's a non-zero benefit to life insurance, obviously, but the
Sure.
point is that you might be able to get similar
Mhm.
provisions from like an annuity,
Right.
for example, or from another product or another investment. So it's just not a
Exactly.
no-brainer. Anyway, we would evaluate.
Yes, love that. The second question was, are there better investment options than the cash value life insurance for their current needs? So,
Probably.
and the thing is that I think one of the hardest things for us to swallow, and hopefully for anybody too,
Mhm.
is to watch people who are uneducated or don't necessarily know what meets their needs best, get sold
Yeah,
something under the promise
that's
that this
unfortunate.
is what you need. It's not like when I'm cooking and I look at a recipe, I know exactly what I need from the store. I'll go and get exactly that. I don't have anybody following me around at the store trying to upsell me on shallots versus onions. Like it doesn't work like that. But unfortunately, like conventional education systems and things like that, like none of this stuff is covered. And yet there's still this weird, like taboo notion around like asking questions about it or admitting like
Mhm.
slow down, I need you to explain why you're advocating this versus this when there
Right.
shouldn't be. So yeah, I think that's really important. So we would always look, and just to be clear, when we are working with somebody, we're not just looking at your like insurance policies to see if there's something to be optimized.
Right.
We're looking at your investment plans. We're looking at your 401k options.
Right.
We're looking at every
Your
single
tax
thing that you are
returns.
using. Exactly. You want to try to be optimized at every single facet.
Yeah.
This is just one that I think leaves a lot of rich opportunities
Correct.
to do.
Correct.
And then their last question that they had addressed was how should we manage our funds to ensure that they last throughout retirement while covering all expenses? I think they were really struggling with what should we be looking at because they're recent retirees, and it is what should we be looking at as far as a withdrawal rate, and how do we figure that out, and how can we make sure that if an adjustment needs to be made, that we're making that.
Right. So there's we've given similar answers before, right?
Yeah.
So large risk tolerance conversation to be had, right? If we're talking like $400,000, I'm getting that from like the 300 in various retirement accounts, and then the 100 from the cash value insurance. Was
Those
that
like
right? Did they say
360.
360?
Yeah,
Oh,
yeah,
okay,
yeah.
okay. So let's round up to
300 was the
500.
house.
Okay,
Yeah,
got it. So if we round up to like 500 in the various accounts, and we're
correct.
talking about like a 4% withdrawal rate,
Hmm.
that's like a 20K that they could, supplement their 70K right now with.
Correct.
If they're in like, maybe a 50-50 portfolio or 60-40 portfolio, something along those lines. If they're not comfortable with that kind of exposure, like 60% equity exposure or even 40% equity exposure, if they're not comfortable being in the markets, right, and then slowly withdrawing from those values and just watching their portfolio value decrease over time, it might be worth discussing, an annuity kind of product.
Yeah.
So if our concern, if they come to us and they are like just absolutely adamant that they're super concerned and they're losing sleep over, longevity concerns, running out of money.
Mhm.
Okay. So we certainly would advocate an annuity option. I think that's reasonable
And
at the minimally with the whole life insurance
yeah.
policy.
So, like, based upon, that thread with them, there definitely were concerns about outliving their money and all of that. I think a lot of the concerns stemmed from the fact that they're like, we invested, but we have no idea what it's in. We don't know if
Yeah.
it's correct. So a lot of it was also lack of education. So
Right.
it might be that you're going to educate them on both what their investments are, how your investments can start to support income replacement, and then what an annuity is as well, so that they can be informed in making those decisions. But again, it's not an all or nothing either. Like, they could certainly do like the cash value life insurance rolled into an annuity while still investing other funds.
Correct.
But they definitely seemed very aware of the fact that, like, we've blindly been investing.
Right.
And when he said the various retirement accounts, he never specified this, but it sounded like there were a decent amount of job hopping. So
Okay.
there's
So
probably a
various
lot of,
401ks and
yeah, it sounds like there's probably
IRAs,
various 401ks
likely going to want
floating
to roll
around.
those into a single account.
Yeah.
Um, there's a no, we're getting 70K. There's probably very little appetite or like need for like Roth conversion ladder in this spot.
Hmm.
We've already taken Social Security. I know it's
I
very
never
sad.
thought you would say
It
it.
really is. It's really disappointing to me. And we would still look at it. We'd look at your effective tax rate over time, right? It's just a responsible
Right.
thing to do.
Exactly. I think you have to. And I think that when we know how beneficial Roth conversions are, to not look at that would be a wild disservice. But
Right.
again, there are certainly situations where what's optimal in most, like in 99% of cases, just isn't
Right, and the risk tolerance, it sounds like it could be, they could be very risk averse. And if
on the
that's the
short
case,
side.
then
Yeah.
then we're looking at like what does fixed income provide? How are we going to hedge against
Right.
inflation? Because if we're doing something like a bond ladder, right? So a bond ladder is when you buy a bond that matures in 5 years, and then like if you have bonds that basically mature at every step of the way over the next number of years. So maybe I buy 10 bonds, okay, like 10, let's say $50,000 bonds or something, right? And then each $50,000 will mature at like 1 year,
Mhm.
right? So one's going to be mature at the end of year one, then the next one's at the end of year two, right? I'm going to subject myself to reinvestment rate risk. I have to hope that the rate that I'm getting today is the same rate that I'll get at the end of year one when I go to buy the same bond again, you know, a year or two or 10 years rather. And then I have to hope that the $100,000, or I'm sorry, the $50,000 that was the principal or the face value of this bond when I bought it is going to be worth roughly the same as it was when I purchased it. So we're going to have to hope that, the purchasing power of that $50,000 has stayed roughly the same so that inflation hasn't just eaten it up.
Yeah.
So what can tend to happen if you employ strategies like bond ladders or just anything that with fixed income, really, where you're going to go and get a fixed amount of dollars later at a later date, that fixed amount of dollars at a later date will never have the same purchasing power as it does today, unless we get into a deflationary environment.
Yeah.
That's bad for everybody. So we're probably not going to have. It's probably not going to happen.
Yeah.
Part of the Fed's mandate is not to let that happen.
Right.
Okay. So
The
anyway,
dangers are.
it's worth less later than it will be today.
Yeah.
So what tends to happen is the bonds will spit out coupons or interest payments, and people will spend those down,
Yeah.
and then they'll get their money back, thinking, "Well, I'm in no worse position. All I did was live on the interest, right?
Exactly.
But now
I
I'm left
just
with a far less purchasing power than I initially had."
because exactly
So
$100 10 years ago, it's not the same dollars
Correct.
now.
Correct. I mean, everybody talks about inflation right after 2022. So
No.
yeah, still
Yes,
hasn't gone all the way
that's
back
true. I
down.
think we even did a podcast on that.
Yeah, absolutely.
Yes. Okay. So then to put a bow on our Bruce and Rachel's situation, um, the first thing, as always, that we would do is really start with cash flow. They told us how much they spend, but we'd want to verify and analyze
Hmm.
what that cash
It's
flow
super
is and
important
where
here
it's
too
going.
because we're kind of close to the margins, right?
Correct. It's pretty razor thin.
Yeah.
And I think that sometimes what we've seen a lot of is not that people are undisciplined in spending, but if you don't know what you're spending, you don't know what areas you can easily cut out
Yeah,
or
you're
cut
flying
down
blind.
on. Correct. We discussed that there's the possible opening for an annuity. There's the option to roll over the cash value annuity. I mean,
Cash
the
value
cash
whole life.
value
Yeah.
whole life into the single premium immediate annuity would be the advocacy here, but then also potentially putting more into an annuity if it turns out that that really met like that Venn diagram of kind of like where their risk tolerance would live.
Hmm.
Um, we also talked about possible reverse mortgages, being able to kind of leverage some of the assets that they have now to help support them um, financially
In
and
later
living
years.
now. Well, exactly.
Typically, like the reverse
When
mortgage will
they're
be like
older.
our parachute at the end.
Correct.
If we had our plan, we spent all of it down, and we're like, well,
Yes.
now we're going to reverse mortgage.
It's your safety
Because
net.
remember, we wanted to bounce the last check, so they wanted to play on this razor's
Exactly.
edge. If you want to dance on the razor's edge,
They
that's just a
do.
risk you're going to take.
When that's exactly it, is that like there will be things that you can't control, like the inflation rate, or like if you're invested, right, how the stock market is doing. And so
Hmm.
as things are starting to go up and down, you may find that there are years that you are like in the red.
Right.
So yes, exactly. Having that as the option there. And then we would also certainly want to look at and identify all of the plans that are involved there, like their various retirement accounts, consolidating those, making sure that all of those floating 401k, IRA things are kind of together and invested in a way that meets their
Absolutely.
goals and their tolerance. And then also making sure that we would identify the pension details to see if there's an
Any
insurance
inflation
need.
riders or adjustments? Yeah.
Exactly. And then just that we would really focus on a lot of education and discussion around risk tolerance to determine what investment options are right for this couple.
Absolutely.
But yeah,
Thank you, Rachel. And thank you guys for
yeah.
listening. If you enjoyed today's show, please review it. And if you have any topics you'd like discussed or financial problems you would like solved, reach out to us at podcast@equilibriumfp.com or visit the website, equilibriumfp.com.
Till next time.
Thanks, guys.